हेलो। यहाँ से समझ में मेरा साउंड करना। हाँ। हेलो। हेलो। Can you hear me properly? Good. Hi, Yashyank.
Hey, my video, I'm keeping it off, so it's a turn on.
Sure. Just share my screen. Let me know if this is coming appropriately.
Thank you.
Mm.
Hi, good evening, everyone, and thanks for whoever has already joined. We'll maybe wait for a couple of minutes and let others also join before we start our session. Good evening, everybody. Thank you for joining session 3 of the 6-part masterclass that we are conducting on what I believe is one of the most significant tax reforms in recent decades, the Income Tax Act 2025. This session, the third part, is focused on how the Income Tax Act 2025 impacts your compliances and your litigations. For over 60 years, the 1961 Act has governed how we file our return, how assessments happen, how disputes arise, and how litigations are handled. Over a period of time, it has become layered with provisos, burdened with amendments, complex to read, and even more complex to interpret. As someone who has spent the better part of the last decade handling assessment, appeals, revision, penalty notices, and prosecutions, I can tell you this, that most litigation in India doesn't happen because people want to evade taxes. It arises because of procedural confusion, interpretational differences, and drafting ambiguities. The Income Tax Act 2025 has made an attempt to fix that. Today, Krishna, my colleague, and I will walk you through what has changed in return filing, reassessment, and litigation, what has changed in penalties and prosecution, how the transitional issues will work, and what this means for taxpayers and professionals. Let's begin. One thing that I can say for certain is that the legislature had not made any changes in the substantive as well as the procedural sections for tax return filing and litigation. As they say, sometimes no news is good news. In this case, it's actually true. Having said that, there are some minor changes in the law that we will discuss over the course of next 15 to 20 minutes. One of the most important things that the law has done is simplified the way the law is written. For all the timelines, there are now tables instead of the multiple provisos that would stretch into pages, highlighting what the timelines are. The sections, the languages have been streamlined, and references have been updated. On your screen, you would be able to see the revised section that we would typically use versus the revised sections for under the new Income Tax Act 2025. As you can see, most of it has been clubbed into different sections with lesser sections and layered lesser layers. Now, going into the important amendments that have been made in Income Tax Act 2025, one of the most important things and one of the most litigated areas in the past has been reassessment. Right? In the past, reassessment has been historically one of the most litigated areas. There were always questions on what is reason to believe, whether the procedure for reassessment has been followed or not, and so on and so forth. As per the present law that exists today, a tax officer is first required to issue a notice to a taxpayer where he has information that suggests that income actually chargeable to taxes and escaped assessment, asking the assessee to show cause as to why a reassessment notice should not be issued. Based on the response of the taxpayer and the material that he has in record, he can actually form an opinion whether there is an income that has escaped assessment, and then with approval of the specified authority, he would pass an order determining whether this is a fit case to issue a reassessment notice or not. Under the 1961 Act, only if the information under the 1961 Act, there were certain specific exceptions under which an officer need not follow this provision under section 148A, which is now 281. One of those specific cases were where under a scheme for calling of information, the AO has actually received some information, which is typically a sections 132 to 133, which is your search, requisition, etc. Now, what this 2025 Act also intends to do is include two more cases, where one of such cases is where it's a GAR scenario and where the approving panel has actually declared the arrangement as an impermissible avoidance agreement and has issued AO certain directions. The second scenario is where there is an actual finding or a direction from a court or a tribunal in any proceedings, whether tribunal or otherwise. Right? Therefore, in these cases, what the result has is that if any of these two cases now also additionally exists, the income tax officer is not required to actually issue a notice under 281, making up his mind whether there is an income escaping assessment. the income officers can directly issue a reassessment notice under Section 280 of the Act. However, balances and checks, as always, have been placed on the power of the assessing officer. Under Section 280 and as well 148 of the Income Tax Act, where it's a scheme for calling of information at that point of time, where because the procedure under 148A was not followed, the AO had to take approval from the specified authority before issuance of a notice under 148. In this cases also, while the due process under 281 is not required to be followed where it's a GAR case or where there is an order or a direction from a tribunal or a court, the income tax officer has to take specific approval from the income tax authority prescribed in the section before issuing a reassessment notice. I think this in line, while this is not brought about by an amendment in Finance Act, but by way of an amendment in the Finance Act, by the Income Tax Act 2025, this clearly outlines the intention and the intent of the law to say that where there is already a finding by any other court or any other authority that there is an income escaping assessment, no new procedure or no diligence needs to be done by the assessing officer again, while placing sufficient balances and checks on the power of the assessing officer so that he cannot discriminately abuse his power. Under the current section, sorry, just give me a second. Krishna, if you can, yeah, just stay with the slide, thanks. Yeah. Another amendment that has been made in the sections is that no notice under 280 or 281, which is the erstwhile 148 or 148, shall be issued within 1 year from the end of the tax year. While typically this 1 year buffer is mostly so as to ensure that if any return has been filed or if there is any return that is intended to be filed, which has actually not been filed by way of a belated return, the SIC gets sufficient opportunity to do so. This is in line with the revised timelines that we've seen in the Finance Act 2026 for filing the revised return of income, which has been now extended till March 2026. Another amendment with respect to reassessment. Earlier, under the erstwhile Section 150, there was no time limit for issuance of reassessment notices where directions have been given by the approving panel. Sorry, there was no time limit for issuance of reassessment notices where there were an order or directions given by the court or authority. So fundamentally, while there is a time limit, as we are all aware under the Income Tax Act, for issuance of notices, reassessment notices, however, in case where it's pursuant to a finding or a direction by authority under a court order or any revision, reassessment timelines were to not apply. This has now been extended to a case where directions have been given by the approving panel pursuant to identifying an impermissible avoidance agreement. However, as again, there are balances and checks of powers of the tax officer. What the law also now states is that, however, if the original reference that was made by the officer to the approving panel or to the commissioner was actually delayed and not within the statutory timelines, then the statute of limitations will continue to apply. There are a couple of other minor amendments that have been made. One of the other, major amendment in line, with how the world has evolved, we should not forget that the law is now more than 60 years old, and earlier under Section 132, which is relating to search and seizure, it was only presumed that all the physical books, assets like books, bullion, jewelry, etc., were actually owned and were owned by the taxpayer. However, the Income Tax Act 2025 has increased the scope and has also said that any virtual digital assets, electronic records, computer systems would also be admissible as electronic evidence, and it will be presumed that any books of accounts, etc., that are found in electronic format are correct and are also owned by the SIC. This has significantly now expanded the scope of the tax officers where in earlier cases it was only limited to physical books. Now, in the case if they find any digital books, they will have the power to seize them as well, make the taxpayer give them access, and then do scrutiny. This has significantly enhanced the scope, and this is also important. While for taxpayers, it is clearly important that what they send in their mails, etc., is important. It is also equally important for professionals as to what is the kind of advice that they're giving and how it is documented on the mails and communication that we do with our client. There is a small increase in the limitation period where an order giving effect to the appeal order was earlier allowed to be given only from 3 months from the end of the month in which the order has been received by the CIT appeals, by the CIT or the income tax officer. Now that has been extended to 6 months, with a further extension possible up to 6 months with prior approval of the Joint Commissioner. This is a very welcome change, given that 3 months is a very short timeline to actually pass an order giving effect. We've often seen that while the order has been passed, income tax officers, due to various reasons, whether it is assessment, reassessment timelines, or March closure, do not have the bandwidth to pass these orders. And 6 months, which is also extendable up to 9 months, will give income tax officer as well as assessees enough time to get an OG passed. Of course, the other flip side to it is also that it will take more time for the officers to pass the order, which will also, in case there is any refund, which will also extend the period of receipt of refund. Under 263 and 264, which, as we all know, are the 1961 Act provisions for revision by a commissioner, there was a time limit of 2 years from the end of the year in which the order is passed for a revision. Now, where an adverse order was passed by the commissioner, we would often see that the income tax taxpayers would challenge that order before the High Court, saying that this is actually not adversarial to the revenue, and the order that has been passed is incorrectly, or the power has been presumed incorrectly, and this would go and be stayed before the High Court. Now, when the matter would actually come back from the High Court, there would be 10 or 15 days left, and the CIT would not be able to pass an order within that time after giving due importance and due diligence to the taxpayers' contentions and calling for all information and documents. Now, what the 2025 Act has sought to do is introduce a minimum 60-day residual limitation passed for passing revision orders. So fundamentally, if, let's say, once the file has come back from the court or the tribunal to the CIT, if the period to him for passing the order is less than 60 days, he will at least get 60 days to pass the order. This is in line with other sections of the Income Tax Act, where this relaxation and this enabler is already there. I think this is a good move, given that if there is less time for the tax officer to pass the order, it would not be fair to the assessee if he were to pass an order, and it would also lead to unnecessary litigation. One of the last key amendments that has been made in the Income Tax Act is penalty for failure to comply with provisions of 139A. Earlier, under the erstwhile 1961 section, there was an opportunity of being heard, where no penalty could be passed without an opportunity of being heard. While it's a small 10,000 penalty, that opportunity of being heard is now removed, and therefore now for every failure in not quoting PAN or not obtaining PAN, the tax officer can pass a penalty order without the opportunity of being heard. This, in my opinion, is like a double-edged sword. While of course it's good that for small penalties there is lesser litigation and there is lesser administrative compliance for the tax officer. In certain cases, there might be a genuine scenario where, for some reason, there is the assessee has not been able to obtain a PAN, or he has not quoted PAN, or there might be a difference of opinion. In those cases, it could also be that the tax officer is indiscriminately passing the order without the opportunity of being heard. The principle of natural justice is enshrined in the Income Tax Act as in any other law in India, and in my opinion, this while it reduces the administrative difficulty for tax officer, it also reduces or reads down the principle of natural justice. Um, with this, I think we've discussed more or less all the key amendments or the key changes that have been brought about by the Income Tax Act 2025. As I said during the beginning of my speech, no news is good news, and at least from what we've seen in our analysis, there isn't any significant or detrimental change to the 2025 Act. With this, what remains to be answered and what the question that everybody will have on your mind is, what happens to the existing proceedings, what happens to the existing demands, what happens to the existing refunds, and what happens to the existing notices. For that, I would like my colleague Krishna to speak. He would take you through the provisions of what happens to the transition between what happens to the proceedings during the transitionary phase when we move from the 1961 Act to the 2025 Act.
Sure. Thank you, Yashyank. Thank you for taking that up. And good evening, everyone. So as you might have already heard, Yashyank laid out the comprehensive overview of the architecture of the new act and what has effectively changed, more or less in summary, as he summarized that nonetheless, they have tried to just simplify the sections, remove provisos and make it simpler to read for, say, a layman and understand it better, and remove those nuances which could have become a little complicated for a layman to understand. But with that, since there is a law change, there are definitely some hiccups that will come through. As we say, transitions in fiscal legislations are they're rarely linear, and when one is moving from one spot to the other, whether say be relocating your office or changing your phone, we always have something in our mind saying that will my say in the example of a phone, will my data get lost in the transit, whether everything which I have in my old phone get carried forward into my new phone. With that example, in a real world scenario, the context in the current world scenario would be that the concept data represents the preservation of your tax credits, your continuity of losses that you might have, and the jurisdictional certainty of certain long-standing litigations that have been put to rest in the old act. With this thing in mind, we wanted to cover what is happening on account of certain provisions or certain issues which spill over to a timeline which encompasses both acts, whether it be 1961 or 2025. So take an example in simple perspective, like if there is a litigation which had initiated in the time when 1961 Act was in place, but has not been finalized, what happens to that? Will it continue? Will they have to close with it before the new act comes into place? And a lot of questions are on that ground. So in this scenario, that is where we thought it will good to be navigating through the legislative transition. And in my objective, it should be very clear in terms of the taxpayers as well as the tax authorities, because not just for us to plan or as tax professional or as the taxpayers, it is also equally important for the tax authorities to understand how this moves forward. Because this has always been a gray area, but typically, whenever there is a new act which comes into place, there is a repeal and savings section that is brought out through the act itself. In fact, the older act 1961 itself had a repeal and savings clause. But as we move towards a newer act where the thoughts process has further increased, there might be some gaps that were present in the earlier act, which are now also being tried to plugged in. In fact, one clear example was earlier there was no reference to the General Clauses Act, and hence a lot of uh, while judicial authorities were still relying on it, but it was not legislatively brought into the act itself. That part is now covered. In fact, to add to that, and it somewhere seems a little counterintuitive, but even before the act could come into picture and in effect, through the budget, there was another amendment brought into the repeal and savings scenario, which I will subsequently cover. So now there could be broad examples as to what happens to different scenarios. So when you have filed a tax return for a year which is starting before 1st April 2026, the rights, obligations, proceedings, all are being preserved. When I say rights, it could be a carry forward of your losses, your unabsorbed depreciations. You might have MAT credit that is unutilized. All those will continue to be available in the new act. Similarly, if there is an assessment ongoing, it will not be put to rest. It will continue, and it will be continuing as per the provisions of the old law for any assessment year, which is, say, before April 1st, 2026. In fact, even in the returns that we file pertaining to the financial year, say 25-26, uh, it will still be governed by the provisions of the old act, and all the filings also will be taken under that itself. Any other ability or right that a taxpayer had will also be continued. Say, if you had order passed in the month of March, say 20th of March, and you typically have a 30-day timeline to appeal for it, that would still be available irrespective of a new act coming into place. While we had touched upon the Repeal and Savings Act in our first session also, this is, I believe, important for a continuity and completeness perspective when we understand litigation and how it is undergoing a change. And that is where all this becomes very relevant. Any search also which has been initiated under the old law will continue as per the provisions of the old law and would not be impacted by the new provisions. Similarly, any penalty or prosecutions which were idly an outcome of a proceeding which was undertaken for any tax year preceding 1st April 2026 will be carried forward in the similar fashion as was provided in the older act. While there have been some changes made through the budget, which is to align the older act to the new act, because in this budget we would have seen that not just amendments to one act, but both acts were simultaneously issued, so that if there is an intention to bring in any substantive procedures or amendments, it is reflective of both the acts. And that is where somewhere while we are moving towards a new act, we could not keep aside the older books in place, and we would have to continue reading that in the context of whatever requires that to be. Similarly, any default in terms of, say, payment of interest, any recovery of dues which has been pending and was idly as an outcome of any assessment or litigation which was undertaken in the previous act will continue and would be recoverable, and no rights and obligations, even from the perspective of tax authority, would lapse in this case. Similarly, refunds which are pending, a lot of there's a hue and cry in the public also about the recent return which was filed, and for a lot of people, the refund are still pending. And few people also had the question that, oh, what happens? Should I be granted an interest even under the new act, or since the old act will be um, discontinued from 31st March 2026, will I not be eligible for an interest? So all those things also have been clearly articulated in the repeal and saving sections, and would be available to all the taxpayers. Now, that bit of it was from the perspective of repeal and savings, but however, it is very important to understand that other certainties also. Supposedly, we had taken advance pricing agreement, which idly encompasses over multiple years. So what happens to that as well? So it is very clearly called out, saying that any authorizations which are also given in the earlier act will continue to be available. Any filings that we would have done for any elections, so for supposedly opting for the new tax regime or the old tax regime, we were required to file a form to elect what we intend to go forward with. So those forms would not be required to be filed again, and any sort of authorization which was available would continue to exist. Similarly, for taking an example of a charitable organization, we need not go ahead and obtain a fresh registration. Older registration till the time it is fairly usable would continue to apply. And while we were discussing, and we thought it would be a refresher course for the Income Tax Act 2025, One thing that we could not leave behind was there were some amendments already called out even before the new act was brought into picture. Some of these amendments are very welcoming and with broad two intents in mind. One, to try and reduce litigations as well as make it simpler for the taxpayer as well as the authorities to conclude on any proceedings without having it open for a longer period of time. For a very long time, the Indian judiciary as well as tax authorities have had the brunt of it that the process is broken and the litigations goes on for years and does not reach finality. And based on this criticism, a lot of good amendments are proposed in the budget. While this has not reached finality, but more or less a welcome move in certain aspects, capturing the highlight portions of what changes from a perspective of litigation and amendment, limiting it to that framework itself. One is the block assessment framework. As we all understand, because of search and seizure, there were multiple changes brought in the past and recently. The way we have concluded that when a search is initiated, a block assessment would be carried out for a period of 6 years preceding the year in which the search has been initiated. Now, this was becoming fairly complex that while the tax officers are highly required to review 6 years of information, documents, and conclude on a finding, the timeline which was provided was only 12 months. And hence, to give some more time for the tax authorities to not pass order which is say hastily made but well thought through, the timeline has been sought to extend it from 12 to 18 months so that a well thought through and a writing order is passed and to an extent resolves the dispute at one place rather than laying it out to multiple modes of appeals. Another thing which was apparently important in the block assessment was that it was getting a little difficult because search generally is a coordinated process and might be required to be conducted at different premises. And on those lines, since the last provision said that the timeline to conclude the block assessment was ideally 12 months from the end of the quarter in which the last of the authorizations were made, and that was making it a little complex because people had different search requisitions at different places. To also make that fairly simple, now they have changed it saying that while we have extended the timeline to 18 months, but now it will start from the end of the quarter in which the search was initiated rather than the last authorizations being made. So this brings a lot of clarity, and any assessee which is being subjected to a block assessment will have a clear thought in mind as to what is the timeline for the completion of the block assessment. So a win-win for both parties, I believe here. The second amendment was also related to block assessments, but it was more from the perspective of a third party. So generally, we understand that in case of a third party information, if it is unearthed during a search conducted on another person, the income tax authorities have the right to share that information with the jurisdictional assessing officer of the third person of whose information was unearthed. And in that connection, they were also going ahead and issuing notices to them for the entire block of 6 years. Now, this practically was creating concerns because while information would be pertaining to only a single year, but unnecessary burden on the assessing officer also to look through the entire set of 6 years. Plus, also on the third party because he's being exposed to very uncertain times where suddenly a block of 6 assessment years could be opened and it will be a cumbersome activity for him to keep explaining various questions to them. So with that practical difficulty in mind, they provided a targeted relief where they said if information pertains to only 1 year, then the definition of the block assessment will only stick to that 1 year and hence providing relief to both parties in this case. Similarly, if the information which is unearthed is specifically for a year preceding to the year in which the assessment or the block was the search was being carried out, then the block would consist of the previous year, continuing until the present year. So this again provides some bit of relief to third parties. Third is another welcome move because in a lot of our conversations we keep hearing that only 3% of the Indian population pays taxes, and that is why even the person who is willingly providing and paying taxes for the development of the country is being subjected to unnecessary scrutiny. So why not provide them a measure to at least pay off their liabilities if they would have unnecessarily missed it out and without having a willful intention in mind. On that account, the third amendment is also a welcome move where even though a reassessment notice has been issued by the tax officers, the tax payer could go ahead and file a updated return and putting an end to litigation on that front. Earlier, there was a specific limitation stating that if the assessment has already been initiated, the ability to file an updated return was not available. But now, with a small fee of additional 10% income tax over and above the tax and interest, once paid by the taxpayer, this will go out of the litigation altogether. This somewhere helps the assessees to close the assessment and also protect them from a higher penalty outcome because if they were not to file a reassessment, updated return post subject to reassessment within the timelines as specified under the notice issued under Section 280 of the new Act, they might be subjected to a potential higher 200% of penalty. So now with this, it is again providing a relief to them so that they could attain certainty with a small fee payout. Another move providing the ability for taxpayers to revise their returns and also file their original return in a little longer timeline that was available inherently. This was with the intent that a lot of times, since for some clients, the due date for filing return, which are subjected to TP, were 30th of November, and the timeline available for them to file a revised return was only 1 month from that time because 31st December was the last day. Taking this into practical perspective, a lot of time it was not possible for them to find out even if they have committed mistakes which were not made willfully, and hence it was reducing the ability of honest taxpayer to file a revised return and make corrections for any default. With now the revised return moving to again 31st March, which was in line with what we had some years back, it's a welcome move again, providing some bit of timeline even to the TP cases where additional 4 months after the filing of original return would be available for them filing a return of income, and that too subject to a very small fee of 5,000 rupees. While we had some very welcoming judgments from a taxpayer angle, we also had some retrospective amendments, which was ideally the stance of this NDA government that we would not be having something retrospective. But in the interest of litigation, I believe they have had three major retrospective amendments, which were in the highest court of India, in the apex court, Supreme Court of India. There were three different scenarios, which I'll take up one after the other. So in a lot of reassessment scenarios, there were multiple appeals which were being filed, and there were favorable rulings in the case of, say, Hexaware, where the High Court had ruled that the ability to issue notices in case of a reassessment is only available to the national faceless authorities and not to the jurisdictional officer. Based on this procedural defect, a lot of taxpayers had went into appeal and also had favorable rulings coming their way. But because there was pressure on the Supreme Court and the government wanted to attain certainty and not say jeopardize a case on merits, which was just getting hampered because of a procedural defect of who had sent the notice. In this connection, even before the Supreme Court could hear the appeal filed by the revenue authorities, the retrospective amendment was passed, wherein they said that the jurisdictional officer has the authority to issue notices in the case of reassessment. The second retrospective amendment was in relation to the DRP timelines. Again, multiple cases which were stuck at the Supreme Court level, where initially they were contesting that the timelines provided under Section 153 to complete an assessment are sacrosanct and would not be extended even if there is a timeline provided to DRP to take an action on the appeal. On this account, several cases again were getting stuck because of a debatable issue being carried out. Here, again, a retrospective amendment was passed going back as good as 2009, stating that it was always the intention that DRP reference, if made, would be available with an additional timeline to complete the assessment order. The third part of it is again relating to a procedural defect where assessment orders in various cases notices were issued and there was a hue and cry and multiple high courts had looked at it and there were rulings for and against saying that if there is not DIN available in the notices, the assessment itself becomes void and does not apply. Plethora of cases on this line again, and that is where I believe the legislature took the case in their own hands and said that till the time there is some bit of DIN related references made either in the order or any point of time, this should still be actually acceptable and it could not be made void. So these were the three major retrospective amendments, which somewhere does bring litigation to a standstill. But for those taxpayers who were relying on these judgments, will now have to rethink about their strategy and on their merits, and we could not merely rely on procedural defects. With that intent in mind, it also becomes apparent that in recent times, the rulings that also we've been seeing is more substance over form. Similarly, merely fighting a litigation or assessment for some procedural defects may not be entertained in the future. And even though you might spend up a good amount of your time fighting it in the higher courts as well, it might be turned around by a retrospective amendment later on. So it's be as a practice in our regular activity. Principally, what we conclude is we should see the substance and the merits of the case rather than procedural defects. With this, we move to some other amendments. One amendment which was also in the light of making life easier for taxpayers is that now there'll not be separate orders for assessment and penalty. In our past experience, as we would have noticed, generally the intention was to conclude on the assessment order under Section 143(3) in the old Act and subsequently issue a show cause notice stating that why should a penalty not be issued for a similar case. That was creating ideally a longer process and uncertainty for the taxpayers because they had to, for the same, say, ideally default or miscommunication, they would ideally have to file the similar replies for two different assessment orders. In fact, in certain cases where the original assessment order under the appeal was put to rest, but still we had to continue filing more procedurally to state that the original merit appeal has been concluded. But still, that continued and would unnecessarily bear a cost for getting that done. So now with that in place, the intention is to cover both in a single order so that the timelines are streamlined and it is a little more clarity. Everyone has a little more clarity in their mind. One more welcome move that is proposed to be brought in is that while penalties would be subsumed in the same assessment order, interest on such penalties would not be payable until, say, a appeal order is passed by the CIT or the ITAT as may be applicable. The second move is towards moving penalties to mandatory fees. Some people look at it as a welcome move, and some people look at it as more as making it mandatory and saving the tax authorities time so that they need not get into a penalty proceedings, but rather having a mandatory fee to be made applicable irrespective of the tax authority reaching it out to you. Some example of where this has been changed is, say, if you fail to file your tax audit report, if you fail to file your 3CB in the older scheme of things, or you've not reported your SFT filing. In either of this case, if you go on to file this on a later date, just like when we used to file our belated returns, there was an auto-populated fee of 5,000 rupees payable. Similar procedure might be brought in here, and that is where, irrespective of the tax authority spending time, this revenue will become directly available to them, and hence while this is moving from penalty to mandate to fees, and there's some bit of carefulness that we'll have to keep in our mind, because any default that we keep now will not be subject to any discretion of the tax officer, will be a mandatory fee that will be payable at the time of filing itself. While that was a mix of both worlds, but one thing which could become favorable for assessees in this circumstance is that in older scenarios, any penalty that you pay in contravention of law was to be disallowed for computing your taxes. But now that it is taking a color of fees, one could evaluate at least taking deduction of such fees if and we ended up paying that itself. The third bit of it is again very counterintuitive. While uh, the authorities as well as the finance ministry is portraying this as a rationalization of penalty proceedings in case of unexplained credits, where the base rate has been brought down from 60% to 30%. But if you go into the nitty-gritties of it, it now does not stop at 30%. Earlier, there was a uh, fixed penalty of 10% applicable after applying surcharge cess, which was totaling to 84% in effect of the income which was escaping. But now, while the base rate looks 30, with surcharge says it adds up to 39. But however, it could also further be subjected to a penalty under the misreporting section. While the base case penalty, which was specific to unexplained credits, has been deleted, now it is brought under the garb of the misreporting section, which would probably make it closer to 99% in our understanding. And hence, effectively, while they are saying the penalty provisions are being rationalized, depending on situation, it could actually end up paying more in these circumstances. However, I would not leave here, because there is also something favorable in mind, because earlier there was no distinction made whether the unexplained credit was found out by the tax officer or uh, self-explained by through updated return or any other mode by the assessee himself. Now that distinction by a fine reading is being made available. And in case a tax payer files his own updated return and discloses these things on his own, the penalty of 200% will not be applicable. One more related amendment to this was the immunity from penalty on misreporting. Um, in the earlier tax act, we had a provision that if the penalty prosecutions has been initiated under the category of underreporting of income, and you were to give a declaration to the authority saying that I will pay off the demand within 30 days, which is idly called out in the section order, and I agree that I will not be filing an appeal. Immunity from the penalty was being provided, but that was only restricted to an underreporting scenario. Now, with this proposed amendment, it is sought to be extended to a misreporting scenario as well, but with a additional payment of 100% of the tax. And in case the case which is involved is in relation to unexplained credits, 120% of the tax. Some other welcome moves is that often we used to hear from multiple directors and officers involved in the day-to-day operations of the company is that one small default on account of compliances, and suddenly there lures a risk of uh, prosecution on the DNO category of people, and that has been going on for a very long time. So a small default of not filing a return in time or not filing a TDS could have ended up putting you in a scenario where you're subjected to a prosecution. Now that is trying to move to a more trust-based tax administration, which I believe in the recent disclosures, the government has also been saying that we would want to appreciate someone who is honest and someone who is doing their fair bit of thing very honestly. And that is where, while the earlier penalty and prosecution sections used to, rather not penalty, only prosecution sections used to say that prosecution shall be initiated. Now that is being moved to more discretionary approach, and in a lot of cases also curtailed down to a staggered approach where, say, for smaller defaults, a mere payment of fine should be suffice. However, for larger defaults or habitual offenders, that would increase. In a sense, meaning that routine compliance failures will not be seen as major failures, and merely by payment of some smaller fines, it could be cured. One specific example that we had taken was uh, deduction or collection of taxes and non-payment thereon to the government's treasury. In those cases, ideally, earlier it was seen as if you were taking away government's funds, and that was seen as a fair breach of the Income Tax Act. In those lines, also, some bit of it is being tried to be totally decriminalized. Supposedly, in a case where the TDS was to be deducted on a payment which is entirely in kind, no longer those kind of cases no longer are subjected to a criminal proceeding. However, where there is a monetary payment involved and there is a deduction made, but payment is not made thereafter, there is a staggered approach of looking at those offenses. If the default is of less than 10 lakhs, the taxpayer or the directors or the officer could be made to pay only a small fine and move ahead. However, if it increases beyond a certain point at time, as you see on the screen, 10 to 15 lakhs could land you up for an imprisonment up to 6 months, including fine or both. However, if the um, tax which has been collected is more than 50 lakhs, the imprisonment could go up to 2 years with fine or both. This would also be extended to 3 years in case of habitual offenders. But still, looking at this from the point what was there earlier is a welcome move, because earlier it was a rigorous imprisonment of 7 years, and now it says simple imprisonment of up to 3 years, even in case of habitual offenders. So, some bit of it is a good move, because ideally this could lead to a scenario where, while you're trying to focus on your operations and business, smaller defaults which may not be avoidable in certain circumstances, but also expose yourself to criminal proceedings which would not be ideally welcome, but going ahead in the same fashion of honest taxpayers and following a path of trust-based tax administration. With this, we come to the end of the session we had. We are open for questions. But in conclusion, what ideally the takeaways we had was, in sum and summary, the intention of bringing in this act was to make it simplified, delete some sections which were no longer relevant, make it simplified in the manner of, because earlier we used to see multiple provisos being added, multiple other complications being added, and that led to scrutinization. But as we step into this new phase, it is pretty exciting. Um, but as we move ahead, would we see no more litigation? Probably not. We would still be having certain difference of understanding and still a lot of things to move ahead. But it is a good starting point for new professionals that are coming into this field. It's a good way of relearning um, the basics from the base of it. It might be a little uncomfortable, because earlier when you used to wake up and any questions around income tax, it was fairly easier. Now those basic sections of 56 to 10, 45 CA, section 28 would no longer be available, and will also take some time to get acquainted with the new sections, and so will be from the other side as well. But happy to take any specific questions that you have in mind, or yeah. So yeah, hi Manas. There is a way to access the last two sessions. We share the based on request. After the session, we will be able to share the recording along with the base material which was used.
Manas will put a common email ID in the chat, and you can write to them and they will give you access.
I believe, Krishank, there is a question. Someone is asking that can you clarify whether limitation period that has already expired under the 1961 Act can in any way be reopened or extended because of the new timelines or savings clause under 2025 Act? Would you want to take this up? Sure, I'll take that up. So there is not a permanent closure on whatever was there earlier, as discussed in our earlier discussions. Anything which is like a right or obligation in the previous act would continue to apply. So any limitations will continue to exist. And similarly, proceedings which are continuing to be available could be continued until their closure as per the provisions of the old act. There's another question asking about the amendments on the TP front of it. So there's another welcome move which has been brought around from the perspective of TP, where um, there's the intention was to make it a little more attractive for the global capability centers, or we as we call GCCs, where a safe harbor has been extended to them. Earlier, the safe harbor was in terms of different levels of revenues and different categorizations, and the rate which was applicable on them extended from 17% to 24%. But with the recent disclosures and the proposed amendments in the recent budget, that is sought to be extended to larger GCCs up to the turnover of 2000 crores, which is earlier restricted to 300 crores. And the rate has been brought down to as low as 15.5%, which is a welcome move and should be and much appreciated by the GCC community as well. This kind of makes it also from the perspective of litigation fairly easier, because a lot of companies were already offering 15.5% as the markup on their cost of services. And this would not just be restricted to a small segment of GCCs, but also encompassing a larger group. Sure. I believe we're done with it. And thank you everyone for attending the session. Hope you found this insightful. Any further questions that we receive, we will probably reach out to you and give you our clarity. Thank you so much for your participation.